Google has once upon a time been one of my favorite investments because of the reach of their products. Now, I don't think it's an exaggeration to say, right, that over the last 20 years, they have been one of the most important and influential companies in the world. You see, if Google ceased to exist today, many of our lives will be disrupted, and that's why I loved it as an investment, especially in the 90s and the low hundreds. However, after nearly doubling in price, is it still worth having Google as part of your portfolio today? And so this is going to be part of an ongoing series where we look at different stocks and study the investment thesis behind these companies as we build out our portfolio with the aim of beating the S&P 500 over a 5-year time horizon. So let's take a deeper dive. Now, to understand whether or not a company deserves a place in your portfolio, you have to start by understanding which part of the business cycle this company is in. And so in Google's case, it's a mature business generating tons of free cash flow, buying back shares every single quarter. And in the most recent quarter, they actually announced that they're giving out a dividend. The thing is, you see, their stock price has been making new 52-week highs after 52-week highs, and it is our job as investors to determine whether or not the performance of the company justify the price that it is at today so that we can start a position. And in order for us to do that, we have to understand how Google makes money. So if we look at the business model, Google is actually part of a parent company called Alphabet. Alphabet is basically a holding company with many different companies in its portfolio, of which Google is the biggest. And Google has two main revenue drivers, Google Services and Google Cloud. And basically the other part of their portfolio that is not Google is basically classified under this category called other bets, things like Waymo, Verily, and basically these are smaller companies that maybe most of us have never heard of it and don't even know what they do. But basically they form a very small part of Alphabet's overall revenue. So let's break down Google's revenue even further. Google's services is basically made up of two major components, advertisement and subscription. Now, under advertisement, it's quite straightforward. Things like YouTube, Google Search, and even their Google Network, they basically allow advertisers onto their platforms to advertise to the users. The second component of their Google services is basically the subscriptions, which consists of things like YouTube Premium, YouTube TV, YouTube Music, or even things like Google Drive. So basically the services that Google provide to other people, and people pay a monthly subscription or even yearly subscription for some of these services. These two components basically form Google Services, which is the main bulk of their revenue driver. And so when it comes to Google Services, right, this is actually already quite a mature component of their business, especially their advertising one, where their market share is already established, and basically they are the market leader in search. So what gets investors excited is actually the new component to their business, which is Google Cloud. Now, at this point in time, right, they are only the third biggest in the world in terms of market share for cloud computing, behind Amazon AWS and Microsoft Azure. However, this is the fastest growing component of their business, which is what makes investors excited. And in the most recent quarter, we actually see their cloud revenue increasing and accelerating its pace of growth, and that is something for us to keep track of moving into the future, and I'll explain that more later on in the video. Brings us to our third point, the total addressable market. Now, when we analyze Google's revenue, right, we see that the major component of their revenue comes from advertisement, and their fastest growing component comes from cloud, and these are the two total addressable markets we need to look at. When we understand the advertising side of Google's business, right, we actually draw a very strong correlation with their ability to generate strong advertising revenue to their dominance in the search engine marketplace. You see, even after the emergence of like ChatGPT, working together with Microsoft Bing, Google still has a 92% market share in terms of the search engine market. And this dominance in this marketplace basically gives them an edge over other competitors when it comes to advertising. And when we look at the digital advertising market, right, we can actually see that it's projected to grow up to a $1 trillion market by 2030, which is about a 14 to 15% CAGR over the next 6 years. Now, to understand why investors are so excited about Google Cloud, right, we have to take a look at this report that was released last year. The cloud computing market is basically projected to grow at 18% CAGR all the way through to 2032, making it a $2.5 trillion industry. And so as GCP continues to gain market share, investors are hoping that this will continue to grow and become a bigger revenue driver for Google. What it does for Google, right, is actually to balance out the revenue it generates through advertisement, which is a very cyclical business. And this growth in cloud revenue will basically allow Google to create a more resilient business. And so after understanding how Google actually makes money, right, we actually look at the actual numbers that the company give to us. So basically in Q1 2024, actually what we observe is that Google made about $80 billion that quarter, which is up 15% year over year. So for a company of Google size, right, that's actually pretty good. As we mentioned also, Google Services basically generated the bulk of their revenue, about $70 billion, right? That's the advertising and subscription platforms. And then Google Cloud generated $9.5 billion. That's the fastest growing component. And then the other bets, which is all the smaller companies that we talked about, generated about $500 million in revenue. Okay, but we actually need to dig a little bit deeper into the quality of the revenue, because you see, if you just look at Google Services by itself, although it is the biggest component of Google's revenue, right, it is actually growing slower than Google Cloud, which is why investors are so excited about Google Cloud growing at 28.5% year over year. And so basically, if you consider that the cloud computing market is growing at 17.8% and we are growing at 28.5%, which means that we're actually taking market share. And so if we look at the historical revenues of Google, we can actually see it paints quite a beautiful picture. Revenues are growing, but we can also see that the growth of revenue is slowing down, which is why the cloud platform really needs to step up in terms of the revenue it generates in order for Google to see a new S-curve. So in terms of Google's revenue, I'm not too concerned. In terms of optionality, they have a lot of new advertising revenues to make money with Google Cloud. However, the only thing that I would say is that maybe their revenue is slightly concentrated towards advertisement, and advertisement is a cyclical business. So if we do see a recession in the next 1 or 2 years, then we know that actually the advertisement revenue for Google will be affected. And so after looking at revenue, right, we have to look at the profitability or the margins of the company. We actually see that their SG&A, their sales and general and admin is down, marketing is flat. So basically the operating margin went from 25% to 32%. That's something that we want to see. And net margins actually also expanded from 21 to 29%. And so if you consider the cyclical nature, right, of Google's advertising business, right, Q1 and Q2, people actually run less ads compared to the second half of the year because of all the special occasions, then actually this bodes well for the future. Now, if you just zoom into Google Cloud and compare it to its peers, right, which is Amazon AWS and Microsoft Azure, we can see that both of these companies run their cloud platform at about a 30% margin. However, if you look at Google Cloud in this last quarter, their margin is only about 9% as they are continuing to scale, which means that there is actually a huge potential for them to scale up to that 30% margin, which will have a large impact in terms of their profitability. And if they can get to a scale of Azure and AWS, then we can expect margin to at the very least double from here on. As I was mentioning in my previous video, if you like this kind of content, now is the time to hit the like and subscribe button. Thank you very much, and back to the video. And as I was mentioning previously, right, the profitability basically helps to inform us on how strong a company's moat is. And so basically one of Google's biggest moat, right, is their hold on search, their dominance in the search engine market, right? And so when it comes to Google search, right, OpenAI and Bing basically was trying to compete against them. However, I think it still falls short based on the user experience, and Google basically has a wide range of data compiled over the years. So as we can see from its revenue and its profitability, right, its stranglehold and its dominance in this search and advertising space is still quite strong. And so Microsoft and Bing, if they want to eat into this market, still have a long way to go. You see, the thing is that Google has actually already become a verb. We don't say I go and search something, I say I go and Google something, right? So Google has actually replaced the word search already. So I think why companies actually like Google so much, right, is because there are high conversions if you rank for SEO. What this means is that when you type in something into Google search, right, if you are the first page of Google search, there's a 25% chance that someone will click into your website and buy something from you. If you consider that they have 8.5 billion searches every day and a 92% market share, right, then you can see why their moat is still so strong over here, right? And I would say that their moat is quite safe. The second competitive advantage that I think Google has is basically YouTube. You see, basically we used to think that long and short form content cannot coexist, that when TikTok and Instagram Reels start to come out, then that will be the death of YouTube. But over time, we have seen that that is not true. The viewers are not mutually exclusive. That means if you watch short form, you will never watch long form. I think they both cater to a different group of viewers. That's what we have come to realize over the year. So basically, different social media engages different types of viewers, right? So YouTube basically tends to be viewers trying to learn something or nearing the end of the buy cycle, whereas TikTok and Instagram may cater to a more casual viewers. So when we look at YouTube, right, I think their moat here is still quite strong. There's 2.5 billion logged-in viewers every single month, so that's basically nearly half the world, and it's the second most visited website behind, of course, Google search. Another two aspects of the company's moat, right, is basically Google's AI capabilities, right, and Google Cloud. Now, when we talk about Google's moat in terms of its AI capabilities, right, I do think that Gemini is a very capable AI. We have many investors and basically people that do research on the companies have actually confirmed that Gemini's AI is as good as ChatGPT. So let's just be very frank, their launch of Gemini was absolutely terrible. I think the public perception of Google basically was at a very low point during that point in time, which is why their stock valuation actually went down also during that point in time. They made a horrible job of releasing their Gemini AI. They were slow to it, they were clumsy, and basically Microsoft beat them out of the gate. And Google are playing catch up now because Microsoft has been working so closely with OpenAI and they're rolling out products so fast. And I think one of the biggest things that people actually miss out is basically the integration of Copilot with Microsoft's products. See, the more people actually use Microsoft products and they actually get used to using Copilot, it's the same thing as Google search. Over time, if they are not fast enough to catch up with what Microsoft is doing, people are going to get used to using Copilot and Google will always be second fiddle to them. And another thing that was a little bit concerning to me, right, it was that basically because there were actually a lot of reports that Apple was in negotiations with Google to make Gemini AI part of their platform. However, somehow or rather in their last earnings report, actually Apple announced a partnership with OpenAI. So does that mean that they are totally not going to use Google's AI anymore? Not exactly very sure. We have to basically keep track on this in the quarters to come. Now, in terms of cloud computing, right, Google is third place behind AWS and Azure. So the moat here is not very, very big. However, because of its growth and its profitability, I think its moat here is still slightly stronger than what it has in its AI. And Microsoft really has been executing like crazy. And this is why many people have been questioning the management of Google in this respect. And I think some of this criticism is warranted. So after we understand the revenue and the profitability, let's take a look at the balance sheet to basically see how financially sound this company is. In terms of cash and equivalents, they have about 24.5 billion. Short short-term investments of about 84 billion. And so this is why, right, despite the rising interest rate, companies like Google are not so affected because all they do is they take their large pile of cash, put it into treasuries for a safe 4% yield, and their total debt is only about 28 billion, which means they can pay off their debt today if they wanted to. It's just that they are choosing not to do it. And if you look at their assets to liabilities, the current assets to liabilities ratio, it's at 2.2 times. And so this means that they have a lot more assets than liabilities, and this company is well capitalized, not in any danger of going bust anytime soon. And this is basically a no-brainer for a company like Google to have such a strong balance sheet. If you're looking at companies, right, then it is smaller companies especially, it's important for you to really assess their balance sheet, to dig deeper, to see how financially sound are they and whether or not they have enough cash to run the companies. But for Google's case, it's actually quite a strong balance sheet. Not quite strong. It's a very, very strong balance sheet. So basically, they can pay off all their debt anytime they want to. They just choose not to, and that's basically the kind of position that I like companies to be in. And the next thing we want to consider is the cash flow analysis. So basically, when we look at the cash flow, right, we're interested in the capex of the company and how much free cash flow it's generating, right? So the management has actually already told us to expect capex to expand going forward because they're expanding their AI infrastructure. So now, how this will affect their free cash flow, right, remains to be seen. However, because they're generating such strong free cash flow every single quarter, it's not something that we have to worry about. It's just that their free cash flow may start to decrease because of their increased capex expenditure. So that is something we have to look out for. And how that informs us basically is that since we know, right, free cash flow is going to take an artificial hit because of their expansion of their AI capabilities, then we may not want to use free cash flow in terms of our valuation models and want to use other valuation methods instead. And I'm perfectly okay with companies increasing their capex, expanding their capex, as long as it results in higher margin, as long as it results in higher revenue. So that is something I will really be keeping my eye on. Now we can see that Google also bought back about $15 billion worth of stock and will continue to do so in future quarters, and they also pay out a dividend about 20 cents per share. So after considering all these things, right, we come to talk about valuation. And because Google is actually a mature company, it's possible for us to run a DCF on Google. However, I think apart from DCF, we also want to compare it to its peers. So if you go on websites like Seeking Alpha, you can actually just click all the different companies that you want to compare Google with, companies that they are basically in competition with, and just look at how people are valuing these companies. So if you just look at the very typical PE ratio, right, Google is at 27 times PE. Compared to its peers, it's actually, in a sense, a bit lower. Google and Meta are actually around the same at 27 and 29 PE respectively, but it's much lower than things like Amazon and Microsoft, even slightly lower than Apple. Now, if you can actually take a look at this list here, Alibaba is at about 16 times PE. So you say, hey, Alibaba is better, but then you have to bear in mind that that is low because investor sentiments towards China stocks are at all-time low at the moment, and so that's why the valuation here is also as such, basically reflecting investor sentiment. And so Google, why is it 27 times? If you actually ask me for a reason, I would think that basically if you look at how they executed their AI, right, is basically the market is not really giving them an AI premium compared to companies like Microsoft and Amazon. This is not to say that their AI capability is actually worse than these companies, but like I said, because of how they actually released their AI, right, and the way that they made a mess of the whole release of Gemini, I think the optics of Google is actually quite bad. So because of that, they don't really have an AI premium compared to some of the other companies. So if you actually believe that they're supposed to be valued a little bit higher, then there may be some upside here when you compare these kind of valuations. So if you look at the forward PEA ratio and the price to free cash flow, right, you basically get the same picture. So if you run a DCF, actually basically what you see is that I've run a 15% revenue growth this year, decreasing all the way to 10% over the next couple of years, and a 3% terminal value. I believe that EBIT expansion over the next 2 years from 28 to 32%. This is basically the impact that I expect from Google Cloud. So of course, if Google Cloud does not expand and grow as expected, then this investment thesis may not play out the way I thought it will. Tax payable, I keep it quite consistent, and basically the capex, right, I run it at 16%, decrease all the way to 8 to 7%, and basically how I get this is basically looking at just historical values, right? And so basically once you run all these numbers, if you use the perpetual approach, you get a valuation of about $184. If you use the terminal multiple approach, then you get about $210. So basically when you look at these two things, you want to sum it up, the average price of Google is about $197, which is more or less about the fair price today. However, you actually want to give yourself a margin of safety when buying this, about 10 to 20%. So I would say that if someone wants to start a position, I will feel more comfortable buying in the 160s, 170s range than where it is today, if you actually want to have a bigger margin of safety. And so that brings me to my next point, which is management. And what we want to do is to assess the track record of management and basically look at some of the comments that management has given to us. So if you look at just the last quarter, looks beautiful, beat across the board. And if you look at the historical results in terms of their earnings, right, their EPS, actual versus consensus. I think we can see that it's actually quite a good result other than in 2022. Every single year other than that is a beat. So we can say that management has a pretty good track record in terms of producing a strong EPS for shareholders. Okay, so when we look at management comments, right, we can actually see what management are tracking. And management is basically telling us that YouTube and cloud will exit 2024 with a run rate of 100 billion, which means that we can expect that moving into 2025, these two components will generate about $100 billion in terms of revenue for them. And so that's something that we want to keep an eye on because we talk about it. YouTube and AI, these are two of the moats that Google have. And if they're able to do that, that means that their moat in these two areas are still strong. And so the second thing that management said, right, is that their AI infrastructure is the best. Now, I'll really take this with a pinch of salt because every management is going to say their own company is the best, right? But there are two things here that I want to expand on. Firstly, if their AI infrastructure really is the best and their own GPUs are performing well, then over time they do not have to be so beholden to companies like Nvidia already. So that is good, which means that they're able to cut costs on that at their end. Now, the second thing I want to talk about is that yes, I actually do believe, right, to some extent, right, that their AI infrastructure is good. Whether or not it's the best, I don't know, but I think it is comparable to what other companies have. However, what happens is because of their poor execution in the past, public sentiment towards their company and towards their AI is at an all-time low. Because we actually see investors such as Bill Ackman who have deeper insights into the company, they are able to have the backdoor access to these companies, actually say that, hey, you know what, the AI software that Google has is really comparable with the rest, and they just need time for it to get up to speed and for people to change its impression. So like what I said, right, what we're actually looking for is for the public opinion of Google to change over time. Now, the next two things that management mentioned, we already know, so I don't want to touch too much upon it. Google search mode is growing, yes, and then capex is increasing this year as they build out their AI infrastructure. And so the next thing to consider is basically what analysts say. I really, again, like I said, analysts, sometimes you have to take what they say with a pinch of salt, but it's basically good to use some of their reports and some of their articles to basically challenge your own perception of the company. So in terms of analysts, right, they actually expect EPS of $1.84 in the next quarter, revenue of about 84 billion. So in terms of the EPS revision, 36 analysts actually increased the EPS revision upwards after the Q1 2024. So that's good. Basically, they're expecting higher earnings for Google in the coming quarter. So 34 analysts actually say it's a strong buy. Now, if you look at the average analyst projection, right, it's about $191, which is quite close to our DCF. If you actually remember, we had a DCF of about $197. But like I said, analyst projection, right, sometimes take it with a pinch of salt. It's good to know what you're expecting. But you know what? If Google's price go down, they will lower their price target. And if Google's price go up, they will increase their price target. So really, it's nothing much to see over here. Right, so that is basically something just for us to consider, for us to understand what other people are thinking about this stock as well. So if you ask me what are some things I'm actually taking note of in the coming quarters, right, I think the first one would be cloud growth and margin expansion. Because I look at how companies like Amazon and Microsoft are growing their cloud business and the margins that they have. I expect that as GCP continues to grow and scale, right, we actually see similar margins from GCP, which means that as a result of growing GCP, their margins will expand as well. So that's something I want to keep an eye on. The second thing I want to do is basically to keep track of its increase in capex. So what do I mean here? There are two things I want to keep track of. I think the first thing is I want to see its impact on free cash flow, whether or not free cash flow will still be a viable metrics to value Google on in the coming quarters, especially if they're going to artificially inflate their capital expenditure to invest in AI infrastructure. Which brings me to my second point. If they're going to invest capex into their AI infrastructure, then I have to see more results when it comes to Google AI in terms of its growth, in terms of its profitability, in terms of basically the wider adoption of Gemini. Because right now as an investor, I'm taking a hit on the free cash flow that you're generating for the company because you're telling me that I want to invest this so that I can make more revenue, generate more profit. So I want to see that more revenue and more profits in the coming quarters. If you ask me, I think Google is a fairly valued company at these prices. However, I won't be in a hurry to buy. Basically, what I'm waiting for is a pullback into some form of support. Or if you just look at the discounted cash flow, just take a 15 to 20% kind of margin of safety somewhere in the 160s, 170s zone. That is where I will feel a little bit more comfortable if anyone wants to start a position. Definitely not at today's prices. It's fairly valued. Some people might even consider it slightly overvalued. It really depends because it has already run up so much up to now. So I think in terms of Google, that's all for now. Let me know down below if you actually hold Google in your portfolio, how much it is in your portfolio, or if you don't hold Google, whether or not that is something you want to consider putting into your portfolio now with the current AI cycle, or are you more interested in other companies? So thank you for your time and I'll see you in the next one.